Alphabet just reported its latest results, and the earnings looked incredible. In Q2 2026, revenue reached almost $120 billion, up 24% year over year. Reported net income came in at $112 billion, up almost 300%. That almost seems like a typo. How can a company possibly make more than $112 billion in profit in one single quarter? And that is exactly why we need to look deeper into the numbers. Normally, you would expect results like that to push the stock price higher. But instead, Alphabet's share price has gone down about 8% over the last month. The stock is still up around 140% over the last 5 years. But the big question for investors is this recent pullback a buying opportunity? Or should investors wait and see whether the current AI excitement starts to cool down? In this Simon Says video, I'll break down Alphabet's business quality and financials, its forward outlook, growth estimates, and scorecard rating, and lastly, its valuation to estimate its owner's earnings and determine a possible fair value of the stock. Before we start, here's an important disclosure. This video is produced by Simon Says Formula. I am a private investor, not a financial advisor, and this video is for general information and educational purposes only. Because this video discusses a specific stock and includes valuation estimates, it may be considered an investment recommendation under EU rules. However, it is not personal investment advice, and it is not tailored to your financial situation. At the time of this analysis and publication, I hold a long position in Alphabet Inc. My position may change after publication. You can find the full disclaimer and methodology in the video description. Alphabet has one of the strongest business models in the world, with advertising as its core engine. Through Google Ads, businesses can advertise across Google Search, YouTube, and Google's network of partner websites and apps. But the company is more than just an advertising company today. Its business can be divided into 3 main areas. The first and by far the largest is Google Services, which represents around 79% of total revenue. This segment includes Search, YouTube, Android, Chrome, Google Maps, Google Play, Pixel devices, and subscriptions, such as YouTube Premium, Google One, and Gemini. The second area is Google Cloud, which is Alphabet's fastest growing segment. Google Cloud provides cloud infrastructure, cybersecurity, data analytics, workspace, and AI tools, such as Vertex AI and Gemini for enterprise customers. Finally, Alphabet also has a category called Other Bets, which, as the name suggests, includes new technologies and long-term projects being developed outside Google's core business. This segment includes Alphabet's more experimental and long-term investments, most notably its self-driving technology company, Waymo. Geographically, the United States remains Alphabet's largest market, but more than half of its revenue comes from outside the US. Overall, Alphabet combines a highly profitable advertising business with an almost monopoly-like position in online search, supported by strong positions in cloud computing, subscriptions, and artificial intelligence. This market dominance gives Alphabet an enormous competitive advantage, which is why I rate its business model positively. Now looking at revenue, Alphabet's growth remains incredibly strong. In Q2 26, revenue reached almost $120 billion, an increase of 24% year over year. On a trailing 12-month basis, revenue reached almost $446 billion, representing growth of 20%. Looking at the longer-term trend, Alphabet's revenue has compounded at an average annual rate of 15.5% over the past 3 years and 18.5% over the past decade. Altogether, revenue has increased by more than 445% over the last 10 years. What makes this particularly impressive is that Alphabet continues to deliver double-digit growth despite already operating at an enormous scale. Looking more closely at where this growth came from, Google Services revenue increased by 15% to almost $95 billion. The largest contributor was Google Search, which grew by 17%, while YouTube advertising revenue increased by 13%. However, the standout performer was Google Cloud, where revenue surged by 82% to almost $25 billion. So Alphabet's growth was broad-based, but Google Cloud was the main growth driver during the quarter. Based on this combination of strong recent growth and an impressive long-term track record, I rate Alphabet's revenue development positively. Moving on to profitability, Alphabet's underlying operating performance remains extremely strong. In Q2 26, operating income reached $40.8 billion, an increase of more than 30% year over year. On a trailing 12-month basis, operating income reached almost $148 billion, giving Alphabet an impressive operating margin of 33.1%. Net income, however, requires some explanation. Reported net income reached more than $112 billion in the quarter and $244 billion for the trailing 12 months. But this was largely caused by a $99 billion gain on Alphabet's investments in SpaceX and Anthropic. Looking past this unusual investment gain, Alphabet's operating income has still compounded at 25.6% annually over the past 3 years, showing that its underlying business continues to deliver extremely strong profit growth. Breaking profitability down by segment, Google Services increased its operating income from $33.1 billion to $39.5 billion. Its operating margin also improved from 40.1% to 41.8%. Demonstrating the exceptional profitability of Google's core business. Google Cloud delivered even stronger progress, with operating income more than tripling from $2.8 billion to $8.8 billion. Its operating margin expanded dramatically from 20.7% to 35.6%. This shows that Google Cloud is not only growing rapidly, but is also becoming an increasingly important source of profit for Alphabet. Based primarily on its strong operating income growth and consistently high margins, I rate Alphabet's profitability positively. Moving on to cash flow, the picture is more mixed. Operating cash flow reached $39.1 billion in Q2 26, an increase of almost 41% year over year. On a trailing 12-month basis, operating cash flow reached almost $186 billion, with an impressive margin of 41.6%. However, Alphabet is investing extremely heavily in AI infrastructure and data centers. Capital expenditures doubled to almost $45 billion during the quarter and reached more than $132 billion over the trailing 12 months. That represents almost 30% of revenue. As a result, quarterly free cash flow turned negative at almost $6 billion, while trailing 12-month free cash flow declined by 20% to approximately $53 billion. A few important highlights stand out. First, operating cash flow has compounded by approximately 22% annually over the past decade. Second, capital expenditure is now one of investors' biggest concerns. The key question is whether these enormous AI investments will eventually generate sufficient returns. Third, Alphabet has partly financed this expansion by issuing both debt and new shares, including almost $50 billion of stock during Q2 and more than $100 billion of debt since the beginning of 25. So although the core business continues to generate exceptional operating cash flow, the enormous capital requirements are placing significant pressure on free cash flow. For that reason, I give Alphabet's cash flow development a neutral rating. Moving on to the balance sheet, Alphabet remains in an exceptionally strong financial position. At the end of Q2 26, the company held approximately $243 billion in cash and short-term investments. At the same time, total debt stood at approximately $113 billion. This means Alphabet had a net cash position of almost $130 billion, as its liquid assets significantly exceeded its total debt. Its net debt to operating income ratio was therefore negative, which clearly indicates a low financial risk. This strong balance sheet gives the company considerable flexibility to finance its enormous AI investments and pursue acquisitions. For that reason, I give Alphabet's balance sheet a positive rating. Now, I use return on invested capital to measure how efficiently Alphabet uses the capital tied up in its business. After subtracting estimated excess cash, Alphabet had approximately $524 billion of invested capital at the end of Q2. Then, I want to calculate the return on invested capital, which measures how well the company uses the capital tied up in its business to generate profits. To calculate its after-tax operating profit, I apply Alphabet's effective tax rate to its trailing 12-month operating income. This gives us NOPAT, or net operating profit after tax, of approximately $120.5 billion. Dividing NOPAT by invested capital gives Alphabet a return on invested capital of approximately 23%. Although this is below the levels achieved in previous years, it still means that Alphabet generates around 23 cents of annual after-tax operating profit for every dollar invested in the business. The recent decline partly reflects Alphabet's enormous investments in AI infrastructure, which increase invested capital before the full financial returns become visible. Nevertheless, a return of 23% remains extremely strong, which is why I give Alphabet's capital efficiency a positive rating. Looking ahead, Alphabet's strategy is centered on using artificial intelligence to strengthen search, cloud, YouTube, and its wider product ecosystem. The first priority is integrating Gemini and other AI features more deeply into products such as Search, Android, Workspace, and the company's consumer subscriptions. The standalone Gemini app now has almost 1 billion monthly active users, demonstrating how quickly Alphabet has been able to scale its AI platform. Combined with Alphabet's existing product ecosystem, this allows the company to introduce AI features to billions of users without having to build an entirely new customer base. To put Gemini's progress into perspective, this chart shows the estimated web traffic share of the major consumer AI chatbots. In 2023, OpenAI accounted for almost all consumer chatbot traffic, but by April 26, its estimated share had fallen to just over 50%. Over the same period, Gemini grew to approximately 1/4 of the market. This suggests that Gemini is developing into a serious competitor to ChatGPT, but it also shows how quickly the consumer AI market is becoming more fragmented and competitive. The second priority is expanding Google Cloud and its enterprise AI business. Cloud revenue grew by 82% in Q2 26 as businesses increased their spending on AI infrastructure, cybersecurity, and software. Google Cloud's contracted revenue backlog also reached almost $514 billion, representing future services that have not yet been recognized as revenue. An important part of this strategy is Alphabet's development of its own tensor processing units, or TPUs. These are custom computer chips designed specifically for artificial intelligence workloads and used to train and operate many of Google's own AI models and services. Unlike competitors that rely more heavily on NVIDIA, Alphabet can combine its own chips, cloud infrastructure, software, and Gemini models into one integrated technology stack. The company also offers access to this technology through Google Cloud, turning its internal infrastructure into a product for enterprise customers. Alphabet's third priority is diversifying its revenue beyond search advertising. This includes growing YouTube advertising and premium, Google One, Gemini subscriptions, Google Play, and its device business. However, the strategy also comes with several major risks. First, AI assistants could change how people search for information and potentially move users away from traditional search results. If Alphabet cannot monetize AI-powered searches as effectively as traditional searches, its core advertising business could face pressure. Second, Alphabet is spending enormous amounts on data centers, chips, and other AI infrastructure. If AI revenue does not grow quickly enough, higher depreciation and lower free cash flow could weaken future returns. Finally, Alphabet faces significant regulatory and competitive pressure. Court-ordered remedies are restricting parts of Google's search distribution agreements, while the company also faces scrutiny involving advertising technology, privacy, and artificial intelligence. At the same time, competition from Microsoft, Amazon, Meta, OpenAI, Apple, and others continues to intensify. Despite these risks, Alphabet's enormous user base, custom AI chips, infrastructure, and ability to integrate Gemini across its products give the company a powerful strategic position. For that reason, I give Alphabet's strategy and risks a positive rating. Moving on to Alphabet's forward outlook, analyst expectations remain extremely strong. Revenue is expected to reach approximately $494 billion in 26, representing growth of almost 23%. Analysts then expect revenue to grow by another 22% in 27, 19% in 28, and 14% in 2029. The EPS forecast requires more explanation. Earnings per share are expected to increase by approximately 81% in 26, largely because of the unusual investment gains related to SpaceX and Anthropic. Because these gains are unlikely to repeat, analysts expect EPS to decline by approximately 23% in 27. This should therefore be interpreted as a normalization from an unusually high comparison period rather than a deterioration in Alphabet's underlying business. After that adjustment, EPS is expected to return to growth of approximately 17% in 28 and 15% in 29. These are analyst estimates rather than guidance from Alphabet, and they could change significantly as AI spending, monetization, and investment values develop. Nevertheless, the combination of strong double-digit revenue growth and continued underlying earnings growth supports a positive rating for Alphabet's 3-year growth outlook. To estimate Alphabet's growth over the next 3 years, I start with trailing 12-month revenue of almost $446 billion. Based on analyst forecasts, revenue is expected to grow by 10.9% during the remainder of 26, 21.9% in 27, 18.5% in 28, and 7.1% during the first half of 29. Compounding these estimates gives us total revenue growth of 71.6% over the next 3 years. That is equivalent to approximately 19.7% annually, and will be the growth estimate used in my valuation model. Bringing everything together, Alphabet receives positive ratings in 8 of the 9 categories. Its dominant position in online search, combined with growing cloud, subscription, and AI businesses, supports a positive business model rating. Revenue has compounded by 18.5% annually over the past decade, while operating income has compounded by 25.6% over the past 3 years. Alphabet also maintains an operating margin above 33%, resulting in a positive revenue and profitability rating. Cash flow is the only category receiving a neutral rating. Operating cash flow remains exceptional, but capital expenditure of more than $132 billion has reduced the free cash flow margin to just under 12%. The balance sheet remains extremely strong, with significantly more cash than debt, while a return on invested capital of 23% supports a positive capital efficiency rating. Alphabet's AI and cloud strategy offers substantial growth potential, although this is partly offset by heavy investment requirements, competition, and regulatory risks. Based on analyst forecasts, I estimate compounded revenue growth of 71.6% over the next 3 years. Finally, my risk assessment produces a required return of 5%. This means I am looking for an owner's earnings yield of approximately 5%, equivalent to paying around 20 times owner's earnings on an enterprise value basis. Overall, Alphabet enters the valuation with an exceptionally strong scorecard. Now we move on to owner's earnings, which is a concept popularized by Warren Buffett. The goal is to estimate how much cash Alphabet could realistically generate for its owners after the reinvestment required to maintain the existing business. Rather than relying on reported net income, which was heavily affected by unusual investment gains, I begin with Alphabet's core operating income. I then adjust this figure for taxes, add back depreciation and amortization, and subtract estimated maintenance CapEx. For maintenance CapEx, I use depreciation with an additional 10% added as a margin of safety. Based on this calculation, I estimate that Alphabet generates approximately $118 billion in annual owner's earnings. This represents the cash the underlying business could theoretically generate for its owners after maintaining its current operations. Based on Alphabet's current enterprise value, the company is trading at around 32 times estimated owner's earnings. Now that I have estimated Alphabet's owner's earnings, I can calculate what the company could be worth based entirely on its current earnings, with no future growth included. For this baseline valuation, I apply a multiple of 20 times owner's earnings, which is equivalent to requiring an owner's earnings yield of 5%. Applying this multiple to estimated owner's earnings of $118 billion gives an enterprise value of approximately $2.36 trillion. I then subtract Alphabet's debt and add its large cash position to calculate the value attributable to shareholders. Finally, dividing that equity value by the number of outstanding shares gives me an estimated fair share price of approximately $203.60. This is my conservative baseline valuation because it assumes that Alphabet's owner's earnings never grow beyond their current level. The previous valuation assumed that Alphabet's owner's earnings would never grow. This valuation instead estimates what the company could be worth in 3 years if it successfully delivers the expected growth. Based on analyst revenue estimates, I expect Alphabet to grow by a compounded total of 71.6% over the next 3 years. Assuming owners' earnings grow at the same rate, they would increase from $118 billion to $202.5 billion. I then apply the same multiple of 20 times owners' earnings and adjust for Alphabet's debt and cash position. After dividing the resulting equity value by the outstanding shares, I arrive at an estimated 3-year growth-adjusted share price of $341.70. It is important to remember that this is an estimated value 3 years from now, rather than a fair value for the shares today, and it depends on Alphabet achieving the expected growth. Putting both valuation scenarios together, Alphabet was trading at approximately $319.70 on the 24th of July. Based only on current owners' earnings, my estimated fair price is approximately $203.60, indicating significant downside from the current share price. Under the more optimistic growth-adjusted scenario, Alphabet could be worth approximately $341.70 in 3 years. However, that represents total upside of only around 7% from today's price, despite assuming that Alphabet successfully achieves the expected growth. I also apply a 10% margin of safety to protect against forecasting errors and unexpected developments. This gives me a growth-adjusted purchase price of approximately $307.50, which is still below the current share price. So where does this leave me with Alphabet? At $320 per share, the market already appears to be pricing in most of the company's expected growth. Even under my 3-year growth scenario, the estimated upside is only around 7%, while the current share price remains above my margin of safety target. However, Alphabet remains one of the highest quality businesses in the world. It has an exceptionally strong balance sheet, enormous cash generation, an almost monopoly-like position in online search, and significant long-term opportunities across artificial intelligence, Google Cloud, YouTube, and subscriptions. For those reasons, I still plan to invest in Alphabet and hold the shares for the long term. However, I may wait for the share price to fall a little further and provide a better margin of safety before buying. Alphabet is an outstanding company, but even an outstanding company can become a less attractive investment if too much future growth is already reflected in its share price. Thank you so much for watching. If you found this analysis helpful, please hit the like button and subscribe to Simon Says for more stock analyses. And let me know in the comments whether you think Alphabet is a buy at its current price. I'll see you in the next analysis.